Good afternoon, everyone. I want to thank you for joining BMC for their October Market Intelligence webinar event. Should you have any questions during the presentation, please feel free to use the chat feature located in the right-hand side of your screen to submit any inquiries. At the end, I will make sure that the questions are routed to the individual they're intended for them to answer during the designated Q&A session. Without further ado, I'd like to introduce now BMC's Vice President of National Builders and ReadyFrame, John Osborne.
Welcome to BMC's second Market Intelligence webinar. My name is John Osborne, and I'm really happy to be here with so many amazing building industry professionals. We are so grateful to be part of such an amazing industry. Housing is hot, and it takes all of us to keep our industry going. Thank you to all of our customers and their employees who are selling and building homes every day. Thank you to our manufacturing partners and all their employees who are creating the products we need. And a special thank you to all of our BMC employees for your safe and consistent effort. What's really cool about this webinar platform is that in the audience today, we have hundreds of people tuning in from around the country. Owners and leaders of home building companies, big and small, contractors, framers, trim carpenters, and other skilled tradespeople, building manufacturing material manufacturers, BMC management and associates. And we also have one really smart economist named Ali Wolf, who will be doing most of the talking today, I assure you. We're happy that you've taken time to join us on this Fall Friday. I'm personally tuning in from Salt Lake City. It's our hope today that you will possibly gain some new perspective, maybe gather a few ideas that you can try in your business, and perhaps be more informed to ask better questions of the people in your circles. Thank you so much for being here. Let's get started. So what we are hearing across the country, so what are we hearing? So home sales are very strong everywhere. Texas and the Intermountain are particularly hot. Remodeling is strong in LA and along both coasts. We are also hearing that home starts are lagging sales as builders' backlogs are increasing. Labor is a common theme and a challenge in most cities, and this isn't just job site labor, it's office labor as well. Drivers in particular have been one of the hardest positions to fill due to the demand for shipping and shopping from home. Multifamily projects and some custom homes have been delayed and put on hold due to the high cost of lumber. Lead times are extending in many product categories, and in some markets, we have run out of the basics. The price for most things is also increasing, except for lumber, which thankfully has begun to come off after all-time highs. We are watching this category very closely. We are also seeing some improvements in efficiency. In Dallas, for example, some builders' cycle times are decreasing and the quality is improving. I think it's critical in this environment that we better understand each other's needs sooner so we can get ahead of the squeeze that we are feeling. And this may require that we partner and plan together more in the immediate future. So this is a view of some of the product categories in our supply chain that are strained. On the left side of the screen are the product categories with what I call stable manufacturing and limited disruption from COVID. But as you move to the right, we have some categories that are significantly delayed or even on allocation. And as you can see, there's a lot more categories on the right side of the screen. Here at BMC, we are working diligently with our manufacturing partners to fill the pipeline with products for your job sites. The more we communicate, the better chance we will have of succeeding. If you have questions about what options we can provide for you to address your supply chain needs, please contact your local BMC associate. So one way we can plan better with you is by converting your plans from 2D to 3D. This design process is integral with our ReadyFrame platform and allows you to plan for exact measurements so that products can be ordered even before framing begins. Here at BMC, we are looking for ways to create capacity and reduce waste in our system. And when you think of waste, it's more than the dumpsters hauled to the landfill. It's all about our time and the resources that we have. How much more could we accomplish if we got it right the first time? As we think about how we can conserve more and waste less, I think about engineered wood products. With us on this call today is our National Director of Engineered Wood Products, Steve Colley, who's going to give us an overview of this critical category. Thanks for all you do, Steve.
Thanks, John. Good afternoon, or I guess morning to some. I thought given the challenges around construction labor, I would use my couple minutes to highlight some of BMC's value add capabilities as they relate to engineered wood, or EWP as I'm going to refer to it. You may have noticed on John's slide, EWP was over there on the right side. It's certainly not been immune to some of the supply challenges. With the incremental year-over-year demand increasing in June, coupled with the recent hurricanes and West Coast fires, we've seen extended lead times, typically some areas, all-time lead times, as far as the number of weeks that the mills are out. BMC is certainly working closely with its strategic supply partners to maintain inventory. We've actually had to go outside of those strategic partners to source EWP, and will continue to do so to keep our customers in wood and keep building. We're expecting the Q4 demand to remain strong. The good news on the supply side is we're starting to see the EWP manufacturers clawing their way back with increased production and previously COVID impacted manning levels, meaning they're able to put people back in the plant, more employees, more footage coming out the door. John mentioned the communication piece. The communication piece there is critical. I said at the end here, how can you help? This was mentioned on last month's call as well. The more over communication, the more transparency to the demand spikes, the better you're able to communicate those to our sales staff and them internally push that through the supply channel, the better off we're going to get through this. This slide highlights some of BMC's saw processing capabilities, such as precision end trim options, TET4 solutions, our ability to pre-cut holes, as well as inkjet labeling materials, all to help you build faster and safer. Similar to ReadyFrame and wall components, these EWP saw processing capabilities reduce waste and labor at the job site. Today, if you're using ReadyFrame wall components, you're likely taking advantage of some of this with your floor systems. Both require BMC's design service teams to be involved. We continue to see a greater growth rate in the volume that's processed through the saws than our overall EWP growth. Again, simply because more people are taking advantages of these capabilities. The majority of our markets have these capabilities, so please reach out to your sales rep if you would like to find out more. With that, on behalf of BMC, again, I want to thank you for your business. Also want to thank Boise for sponsoring today's session. And I'm going to turn it over to Rob Johnson, Vice President over EWP Sales and Marketing with Boise Cascade.
Steve, thank you. John, thank you, and thanks to BMC for having us today. Our pleasure to be here, and thanks to the customers that are out there on the phone for their business. Hi, everyone. I'm Rob Johnson. I'm the Vice President of Sales for Boise Cascade Engineered Wood Products Sales and Marketing. But I'm part of a dedicated team of local reps who work with lumber dealers and builders across the nation to be successful. At Boise Cascade, we make structural framing and distribute building materials. You may know some of the engineered wood product brands that we manufacture. So Versalam LVL, BCI joists, AJS joists, VersaStrand LSL, and Boise Glulands. Shifting gears to our value proposition, one of the benefits of engineered wood is more efficient designs and optimized material lengths to reduce waste. Our software tools are built to easily allow the flow of information between programs. But want to draw your attention to BC Floor Value. Designers are able to visualize how a floor feels during the design phase. You can quickly compare buyers' expectations for floor performance and cost and head off field complaints before a home is framed. Boise Cascade's Sawtech system is a key enabler of BMC Ready Frame process. Boise Cascade software connects the floor layout with automated processing equipment. Boise Cascade continues to invest in software and tools that help lumber dealers and builders operate more efficiently. Pre-cut holes and precision I-joist lengths help accelerate the time from foundation to a dry building. Thank you.
All right. Thank you so much, Rob and Steve. And we are definitely in your corner, Boise, and all the manufacturers that are out there. Now for the headline event, Allie Wolf is going to do a great job here, and we're going to turn it over to Allie.
Awesome. Thank you, John, and thanks to the entire BMC team for inviting me back to go through what we're seeing in terms of the housing market and the wider economy. We've had to learn how to adapt, how to pivot, and in the case that you were describing, it sounds like there were a lot of efficiency gains, and you have to learn. And normally you get to learn from experience, and you get to learn from experience over time, but we've really just been pushed into this, hey, we saw this happen a few months ago, now we got to change it today. And so I'm sure a lot of us on this call have been working harder and longer hours than we ever have. But what you'll see in my presentation today is through all of that, housing at least has been able to be the standout and the strongest sector in the entire economy. So as mentioned, I am Allie Wolf, the chief economist with formerly Myers Research. Now we are Zonda. So if you were familiar with Myers Research or Metro Study or Hanleywood, we had all of these legacy names, and our company finally decided we need to unify as one. So Zonda was our data platform on the Myers Research side that's able to tell clients where are the best-selling communities, what's the best-selling product, what's the new unit size that's in vogue. Plus, we have our advisory team led by Tim Sullivan, our senior managing principal. And through the company, we continue to monitor those 275 plus housing and economic metrics. Now, my role in all of that is to look at these different data points, take a step back, figure out what's going on with policy, figure out what's going on internationally and what's going on across the country to try to come up with some kind of cohesive take on where we are and where we're going. So in today's presentation, we are going to start with the economic backdrop. If you joined us last month, this section will be pretty similar to what I showed, except we have updated data. So we'll talk about how that recovery is going. Then we'll transition into those housing trends, talk about home sales by segment, because we know it's important to know what markets are doing well in general, but also where are you seeing the most strength in entry level and where are you seeing the most strength in the luxury space. And then finally, I'll talk about some final thoughts. Now in sections 1 and sections 4, these are going to be the ones that you're not going to feel that great. I'm going to show you some data that still would leave you with a little bit of question marks. But 2 and 3 is where you're really going to see how strong our standout sector is. So for the economic backdrop, I want to remind you that last time we met, we talked about the K-shaped recovery, the fact that parts of the economy are thriving and parts of the economy are living through what feels like a depression. So let the K-shaped recovery be your economic backdrop that you think about, plus the virus. Because of course, we're seeing cases start to go up again in the Midwest. I'm sure you saw, while we're not Ireland, Ireland is a case study of how they opened up a lot of the different businesses, and because the cases have spiked, they've now gone on a full lockdown again. So any non-essential business can't be open for 6 weeks, and they've acknowledged that that will come with job losses. I'm not forecasting that nationally for us, but I think as we head into winter and as we fall and winter, let's just remember that flu season plus increased COVID cases, no matter what you think about the virus, you may still have some policy intervention or some consumers that decide to self-select themselves out of the economy, which could create additional problems. Let's watch for that. But as it stands, remember, our recession is over. Our recession started in February, it likely ended in May, and that's because the recession's defined basically when the peak of the cycle and the trough. And we hit the trough of this cycle very quickly because, as you remember, we lost so many jobs. Starting in March, April was horrendous. And then it started to look like a V-shaped recovery, and now it's turning more into a swoosh shape for the overall labor front. We added 661,000 jobs in September, which in a normal year, that would be amazing. In today's landscape, that is showing you that the rate of growth of our job gains is starting to slow. When we met last month, I had said 50% of the jobs had been recovered. We, just based on a 1-month change, only moved up to 52%. In the past, we were seeing bigger jumps from 25% to 40% month to month. This leaves us 11 million Americans who are now out of work. And if you want a number that actually makes more sense than that 661,000, when you put this in the unemployment rate, we're looking here at the unemployment rates. And remember that there's a whole bunch of ways that you can measure the unemployment rate, but the headline number is called the U3, and the all-in unemployment rate is called the U6. During the worst of times this cycle, our headline unemployment rate got up to 15%. You guys all remember it. It was really, really painful, really scary, but it's now settled down to about 8%. If you look at the U6 during the worst of times this cycle, we got up to 24%, and we're already back down to 13%. So we look at these numbers, and 8 and 13, this is compared to 10 and 17 during the last cycle. And so as you try to put this in context, this is great because we now have an unemployment rate that is comfortably below where we were during the worst of times during the Great Financial Crisis. And last time we met, what I said to you guys is it's not hitting 10%, it's hitting 10% and staying there. And right now we haven't seen that staying there trend. Doesn't mean it could still not come, but at least we're continuing to move in the right direction. Now, eventually you'll see my slide that then shows you a little bit of a nuance, because anyone who's heard me present before knows that I don't want to just look at the headline. I want to understand what's behind the data. And so we have a unique thing in this cycle in that 4.4 million people have now left the labor force. And you do see people leave the labor force during downturns, but once you see this graph, you'll see that we are at unprecedented levels. The reason this matters is a couple things. One is as people leave the labor force, they are no longer counted as unemployed. And so if you added these 4.4 million people back in, our unemployment rate would actually be between 10 and 11%. So it's kind of making the economy look a little bit more rosy than it is. But an interesting thing is last cycle, you guys remember during the financial crisis, a lot of people lost their jobs. Housing in particular was hit very hard. And we saw people leave the labor force to go back to get a bachelor's degree or to get a master's degree. And that's not what we're seeing this time around. We're seeing that in-school enrollment has actually gone down. The reason people are leaving the labor force right now is because of forced retirements, early retirements, buyout packages, and most concerningly, the fact that families are having trouble with childcare. And men and women, though disproportionately women, have had to step aside. And they've had to leave the labor force to take care of their kids as they do virtual learning. I bring this up because one, like I said, it makes the economic recovery look a little bit better than it is. But two, this is something that if this trend goes on for a while, this creates a bigger problem, a systemic problem in the economy. If we watch this labor force and this number shrinks and shrinks and more people get back to work, then hey, I'm not that concerned. But I always want to look at what are other things to pay attention to. Now, besides that, we also know that those permanent job losers are trending up and continue to trend up. Furlough was the name of the game of this 2020. And we kept saying, okay, hopefully people get called back. Hopefully people get called back. Right now, permanent job losers are at 4 million, below the 7 million during the height of last cycle, though they're creeping up a lot faster than what we saw during last cycle. So we're watching that. And if furlough was the name of the game for employees, temporary was the name of the game for businesses. And our data from Yelp shows that temporary closures, either policy induced or just the business owner decides, that was really high in April and May, started to come down in June. But then we have an inflection point where temporary closures was going down and permanent closures was going up. So that remains another risk to the overall economy, that we're not here to just give you the rosy information, though believe me, there's going to be a lot of really good information I'm going to show you soon. Now, as we look at this, I wanted to then chart out the different markets that BMC is really active in to show you how are the different economies recovering relative to each other. And the blue line that we have here, this is showing you the national average. Remember, I said the national economy is 52% recovered. So you can see here then Las Vegas now tied with the national average at 52%. But it's really interesting because you see Austin just dominating this chart at 70% recovered compared to 50% nationally. And some of you probably saw on LinkedIn, I posted about how we're doing a study in Austin. And my coworker texted me and said, Austin's not hot. Austin is molten lava. So you'll see a little bit later when I show you the housing stats, Austin's really one of those outperforming markets. Jacksonville crushing it, Phoenix, you see San Antonio, Atlanta, Denver, Dallas. It's not just concentrated in one region or one part of the country. But one of the most interesting things to me about this data is as you look at it, if one of your markets is lower on this list, if you're operating in Raleigh right now, you can see it's technically only 33% recovered. Raleigh's housing market is so incredibly strong. And I think I mentioned this last time we met, that's been the most frustrating thing, is normally the economy and the housing market are closely linked, and we're seeing a pretty big gap between those two different trends. So before I dive into the housing section, I want to discuss though that housing is part of just the general broad real estate category. And how are the different real estate verticals doing? Well, if you're in retail or you're in hospitality, delinquency rates are at the highest level we've ever seen. And even recent data through September shows that delinquencies are still really high. So while there are select retail companies, there are select hospitality, hotels that are doing well, it's not uniform the same way housing is. When you look at the office space and student housing space, you aren't seeing delinquencies at the same point, but as we look at office, this is one of the sectors that makes us most nervous going into 2021 and 2022. Is yes, a lot of people are going back into an office, but we're hearing lots of reports from brokers, commercial real estate brokers across the country that are saying when leases are expiring, we're having companies come back to us and they're reducing their footprint. And if that happens to scale, that obviously creates issues as well. So as we look at this, one of the things that I haven't hit on much today, but we remember is the reason the economy is doing very well is at least the $3 trillion we've pumped into the system. And so for parts of the economy, that stimulus money has been a game changer. It's allowed different sectors and different people in today's economy to thrive. Think back of that K-shaped recovery. But when you're in office or student housing or retail and hospitality, and these are all held back by the virus, we know that stimulus is a Band-Aid in this case. And you can try to keep throwing money at it, but until we have the virus under control, we still expect to see some pain in those four sectors. On the other side, new residential, amazing. Resale residential, awesome. You heard earlier talk about remodeling, great. Industrial and storage, another really, really strong sector. And if you want to see how these numbers look, we released our new home pending sales index yesterday. New home sales, contract sales are up 47% compared to this time last year. And Team BMC, I will tell you, ever since your coworker on the last call called it a super V, I have been using that everywhere. So I have totally plagiarized that, but I love it because this is not a V-shaped recovery. This truly is a super V-shape because we're above levels last year, earlier this year, and at the highest level since 2006. Now, you heard John talk a little bit earlier about how we are seeing some of these supply chain issues, though. And partly is not just that builders didn't plan for this kind of success. All of the different related companies, the BPMs, didn't plan for this kind of success. We thought 2020 would be good. We expected growth, 5 to 10%. We didn't expect 47% growth. And that's why you are starting to see those problems start to emerge, is that when housing stalled for 6 to 8 weeks, so did the BPMs on producing some of the materials. We've seen that COVID cases have shut down some manufacturing plants. We know that the relationship with Mexico and China, we haven't seen as seamless as we have in the past. But as we talk about a 47% increase on a year-over-year basis, that's nationally, and we know that you also want to see what's going on in local markets. So here, any of the saturated blue markets are growing between 60 and 100% year over year. And again, like I said last time, I want to see this spread across the country. I don't want to see this in just a few markets or a few regions. And that's exactly what you see. You still see the strength in the Southeast, Midwest, Texas, huge strength in Denver, also Colorado Springs, Boulder, really across the board, California and the Pacific Northwest. So when you pull up the markets, these are large markets with a population over 1 million. These are the ones that just truly have the highest year-over-year change. And like you can see, Denver here, Denver is successful in all of the different price points. So entry level, move up, luxury. We've heard from the CEO of a big builder in Denver that says it's a lot of California in-migration that's supporting some of their strength. But along the list, Indianapolis, Riverside, Jacksonville, Raleigh. Remember, I said just because Raleigh's economy is 30% recovered, you see home sales are up 70% year over year. So the strength is pretty ubiquitous. And I think that's been one of the most interesting things with this cycle, is that last time around, earlier this year, we saw that as the housing market was starting to recover, it was some price points and some locations and some products, but now it is generally across the board. And you can see that here. This is looking at realtor.com data, looking at the days on market. And what I've done here is we're looking at, so Salt Lake City is your example. Salt Lake City had 31 days on market. We wanted to subtract out the 30 days for escrow, which basically is telling you that homes in Salt Lake City are selling the day they're getting listed. You see Sacramento, Seattle, Denver, Phoenix, Las Vegas, Charlotte, all of these markets have homes that are just instantly flying off the shelves. And the same thing's happening to builders. Builders had their communities planned. They said, okay, we expect 10% growth this year, and then they're just far outpacing that. And we're seeing that total units remaining at different new home communities across the country are shrinking a lot faster than builders are able to replace some of those homes. So Houston, Dallas, Salt Lake City, Seattle, Atlanta, most dramatic, off 20 to 30% in terms of total units remaining. And what's been interesting is we have created this new home lot supply index. You guys are literally the first people to ever see this. I didn't even get Jeff's permission, our CEO's permission, to show it. But I was so excited because it definitely shows what we've known, which is that as we've looked at lot supply, these are homes that could quickly turn into starts. It's been this general downslide. We kind of expect that, but it's only gotten worse from our data that's through the second quarter. So we're burning through a lot of the homes, and it's really hard to find large plots of land with lots that are ready to build on right away. And because of this, what we're seeing is builders, even more so than the last time we met, are holding on to this very, very valuable asset. And so when we met last month, I showed you the percent of communities across the country that are raising prices. And so this graph is showing you 3 bars. Your dark gray is last year, the light gray is last month, and then the blue is today. And when we talked about how, in this case, San Antonio, 70% of projects are raising prices month over month, and that's up from about 65% last month when we met, and up from 45% this time last year. You can see Austin, you can see Raleigh, Houston, Charlotte, Salt Lake City, Jacksonville. Even as the months go on, we continue to see that the price increases are going up. And so when I talk about inventory that's tight, like I said, we're seeing it both on the new and the resale side. But we are seeing that builders that are well positioned in some markets that do have some products to offer are able to gain more market share. Nationally, normally new homes represent 10 to 11% of the overall market. Now we're closer to 14% nationally. But look again at Raleigh. I feel like I didn't realize how often this was going to come up once I mentioned it, but you have Raleigh here gone from 25% to almost 30% market share year over year. Austin, San Antonio, Houston, Dallas, Las Vegas, Phoenix, Sacramento, you can see how this is spread across the board. And earlier on, you heard from John, who said that we're seeing that contract sales are outpacing starts. We are working on this afternoon, our 2020 housing starts forecast, but I will say we're revising it up way more than we ever thought we would because there's just a lot of homes that have been sold that haven't yet been started. So we think that will contribute to starts growth. Plus, we know that there is going to likely be a lot of strength in the housing market going into spring selling season of next year as well. Now, a lot of the data I have to show you is through September. So I wanted to give you a little bit more of an up-to-date version now that we're sitting here in middle of October. This is the data from BDX. If you're not familiar with them, think of them like the Zillow of the new home market. And the BDX team is able to look at how many people are on newhomesource.com looking for new homes and how many people are just Googling in general looking to buy a new home. Well, what their data shows through, that's the week starting October 11th, demand is still up 38% year over year. And it's come down a little bit from when it was really, really high in parts of June and July, but that is remarkable. And while this is not actually people buying homes, I cannot say that this is actually buyers. This is people that are actively searching, and this data has been very closely correlated with what we've seen in home sales basically throughout the entire year. So as we look at this though, remember how I said that it doesn't matter what market you're in or what price point you're hitting. I showed you that universal strength by market. Now let me show you the strength by segment. So what we've done with our data, many of you know we track 18,000 actively selling communities across the country, and we like to break out that data by the luxury market, the move-up market, and then entry level. So what you see on this table is basically price elasticity. Entry-level homes are selling 4 per month per community compared to luxury homes selling 2 per month. Makes sense. That should not and does not surprise anyone because that's how builders would plan for their sales anyways. But it's interesting when you take that 4 sales per month per community nationally for the entry level, you drop that into this chart and you look at the BMC markets. A lot of the markets that this team is very, very active in are completely outpacing the national average. Phoenix, builders are hitting 7 sales per month per community at that entry level point. Las Vegas, same story. Now for these 2 markets, I talked about how Denver is seeing a lot of positive in-migration from Californians. You're also seeing it in Phoenix and Las Vegas. But don't assume that Los Angeles and Sacramento and Riverside and parts of California are getting crushed. Because again, it goes back to the uniformity. You can see Sacramento is really benefiting from this move, exaggerated move to the suburbs. Los Angeles is still outpacing the national average as well. Austin, you know, our molten lava market, thriving. When you go to the move up, if you guys were part of our presentation last month, we talked about how our forgotten generation, the Gen Xers, we didn't really talk about them for the past 5 years because they were fairly boring in the housing market. But now because of the lifestyle change, we're definitely seeing the move up market post really, really strong activity. So this is hitting closer to 3 sales per month per community with, again, you start to see some of your common players, Phoenix, Sacramento, Las Vegas, San Antonio, Austin, Denver on this list, outpacing what we're seeing on that national level. And then we move to our top tier. So these are going to be our luxury communities. Again, it's no surprise that the sales rate is lower, but what we see with this group is that the K-shaped recovery, the top half of the K, the people that have stronger and better net worth than they have in the past, and their stock market is going up and they can tap some of that money. Baby boomers are contributing to this. Top tier in some markets, really strong as well. So it's interesting when you look at Sacramento, Phoenix, Denver, Austin, those first four, a lot of those are in migration markets for some of the more expensive metros across the country. So that's contributing to their luxury market being able to capture and outperform what we're seeing overall nationally. But I believe I hit on this last time we met, which is just, I want us to keep paying attention to affordability, because right now things are awesome. And I could stop the presentation there and we all would go home and pat ourselves on the back and be so excited about our market. But we also have to look out for risks. And that's what I hope you can take from this, is there's a lot of strength, but there are still things that we need to monitor regularly, because they could tilt in one way or another and could impact the great growth that we're seeing today. So I won't go through this detailed chart. You can send me any questions if you have them. But basically what I want you to understand is if rates are as low as they are today, but prices keep going up 5%, 10%, 15% year over year, we are seeing that in some markets. We are seeing 12 or 13% home price appreciation. So it's not unrealistic to assume that that's possible. As prices go up, even with rates down, you could see that we start to price out some consumers. And this is assuming that rates stay low, but if the economy continues to improve towards the end of next year, I don't care what the Federal Reserve has said, you could see rates go up. And so we just got to make sure, I've heard a lot of people say, oh, well, homes are going to get so much bigger. Maybe if you move further out in the suburbs, but people didn't want smaller homes. People wanted homes that they could afford. And that's the reason we basically ever did smaller homes. It was for attainability. So final thoughts. I told you I'm going to bring you through this roller coaster, because I started off negative, got really positive, and then we have to address some of the different trends that are really kind of in the middle. And so the first is, if you guys remember GDP. So GDP is the broadest measure of economic growth. And in second quarter, we all knew it was going to happen. The economy dropped by 32% on an annualized basis. And that was the biggest drop we had ever seen in modern history. Now, going into third quarter, we have pumped in, again, at least $3 trillion on the fiscal side from Congress and from Senate, plus all of the moves from the monetary side from our Federal Reserve. Our stimulus staved off a depression. There should be no doubt about that. The stimulus is the reason the economy is thriving today. And our GDP number for third quarter, which will come out, I believe, next week, look for about a 30% annualized increase. Our forecast is 28.5. I think we're a little bit too low. We're going to probably revise that up. But what that means is, if you do not see that the economy recovered 46% on an annualized growth basis, we're not back to normal. I know that the chart that I'm showing you here looks like a V-shaped recovery, but that's looking at growth rates. Look at it in terms of overall economy. You can see third quarter is the last part of the line before it goes dotted. And then fourth quarter, we're forecasting that the economy will still be off 4% compared to where we started this year. And for context, it kind of blows my mind, but for context, during the worst of times, during the great financial crisis, we were down 4% from peak. So it is interesting to see how far we've come and how much we've improved. But even when you're off 4%, you will still feel some pain on the ground, though we have got to believe it will be nothing like the pain and the uncertainty and the really big concern we felt earlier this year. So the economy is recovering. There is no way to deny that. We are lucky to be in housing. There's no way to deny that either. But like I said earlier, we're seeing that those delinquency rates are really high in lodging, really high in retail. We saw this week that TSA activity exceeded 1 million, which was awesome. But if you put that in context, TSA travelers getting on planes still down 60% year over year. So it's improving, and that's awesome. But We saw airlines have done massive cuts, and we know that there are so many associated businesses with this not actually performing the same way it was earlier this year. And then just think about all of the different things we're seeing that didn't happen. Conferences, county fairs, Coachella, minor league baseball, weddings. In a lot of instances, the fact that these things didn't happen have been great for us in the housing market. I'll show you here. The personal savings rate, which I talked about last time, is hitting record levels. And we in housing have been able to benefit from that. And you know that we talked about how millennials haven't been getting married. Or if they are getting married, they're having a more intimate ceremony. And when they do that, they save money, and that's been able to support our growth. And we still have a lot of good things going for us. So as we're looking at the data, and I kind of give you mixed messages about the economy and the housing market, take away this. The fact that interest rates are likely going to stay low for the next 8 to 12 months. The fact that people are relocating. We know that a lot of people will continue to work from home. We know that when they work from home, they want space, and maybe they're more likely to move to that next suburb, and that allows them to continue this housing transaction. And every time people buy homes, that overall stimulates the economy. FOMO. When you see that home sales are up 47% year over year, people want to jump in. So that is a psychological factor pushing this, plus the fact that home prices never came down, the stock market only crashed for 17 trading days, and demographics going into this year were so incredibly positive.
Jack, I'm sure we have some questions for Allie.
Yep, absolutely do. And if anyone has any other additional questions, please feel free to submit them now. The first question we have is, Allie, how long do you think that the price increases from builders are sustainable?
That is a wonderful question. And I'm going to answer it in a couple ways. The first way is that, I don't know if that was a builder ask or if that was a supplier asking, but I've had builders tell me that they check their traffic activity every week. And every week they open it up and they say, oh my gosh, please don't let us have pushed it too high. Please don't let us have pushed it too high. Because frankly, the builders don't know what the threshold is, because we're all living through these unprecedented times. 65% of builders have said they've raised their prices between $3,000 and $5,000, and then the next highest answer is $10,000. So when you consistently do a 5% increase or consistently do a 10% increase, you're going to slow demand. And that will happen. It's not happening right now at all. And so that's why they can keep doing it. I think if we see any movement in the mortgage rate, which I know it sounds crazy, but if you look at the 10-year treasury, which is closely linked to the 30-year fixed rate mortgage, it's been reaching slightly high levels that we haven't seen in probably 6 months. And so that should suggest that rates could go up a tiny bit in the near future. So you start layering in all of these things. People are now spending more money, so they're not saving as much because we actually have an economy that's starting to open and again come back to life. If rates go up at all, and if prices keep going up, something's got to give. So I think we'll continue to see it for a while, because again, builders aren't saying we're going from 10 sales to 7. They're still saying I've raised prices and I keep hitting 10 sales and I don't know what to do. But it isn't sustainable. I just don't have the exact time frame.
Okay, next question for you, Allie, is how can you measure speculator activity in the markets, or can you even measure that?
Speculator, is that meaning like investor?
I'm going to assume it means investor in this case. I'll
Yes.
after the
Yes.
Yep.
Yes. Okay. So there's two different ways, and they're both imperfect. So, and I'll give you what the take is right now too. Actually, there's 3 ways. All right. So way one is you can look at closing activity. But the reason that is imperfect is because you're looking backward. You're probably going to be looking at closings that happened. If we're in October, you're probably looking at August closings. So it's not totally perfect, but it can give you a sense of if you live in one zip code and you bought a home in another, we can kind of assume that that is going to be an investor. The second way that you can track this is through Optimal Blue. I believe their data is free, and I believe if you can't get their data from them for free, you can get it through the American Enterprise Institute, which puts out their data. And what they're able to do is look at rate locks. And so if you're going to buy a home and you're an investor, Optimal Blue is the one who secures that rate lock, and they can then mark you as an investor. And then the third way you can track it is qualitatively through your relationships with builders. And I'll tell you, just from all three of those sources, we are seeing that builders are telling us we are having more investors. We didn't see many investors in the market really for probably 3 months. March, April, May, and even parts into June, we weren't seeing investors very active, but we've seen in the Optimal Blue data, we've seen investor activity go up. And from builders, they're saying that they're seeing investor activity increase. And I personally, I know no one asked, but I personally am very frustrated with that, because that's part of the reason prices are going up as well. And that's making it harder for the everyday person to buy homes. But I also know people are looking for yield, and it makes sense for investors to come in. So it's a little bit of good and bad for our market.
Excellent. Next question we have for you, Allie, is what are your builders saying in your monthly survey that you guys do?
So thank you for the question. And the builder survey goes live on Monday. So I do not have the numbers right now. The most recent data I have is from, it would have been the same stats that I showed you last time we met. So we have a new one coming out, and we're asking some new and interesting questions too. So I don't have a better answer than last time. Builders were telling us sales were great and they weren't seeing cancellations, and rising prices were not causing any issues. They were still selling homes as quickly as ever. They were saying that governmental delays are becoming a very big problem. Supply shortages are going to hurt their ability to close some homes this year and into next year. And they said labor shortages were bad. So I know those are the same things you guys are dealing with on the ground, but that's what we saw last month. We'll have an update next Wednesday with our new data.
Excellent. Okay, I'm going to give it 30 more seconds here to see if we get any more questions in. Most of what I'm getting here, Allie, and to our speakers, are just how much what a great job everyone's done, and how much they find the content presented as being very valuable.
Oh, that's nice.
Allie, Allie, this is John. What do you think for the next 2 quarters? You think winter's going to feel like summer?
I do think we're going to continue. Yeah, I think the next 2 quarters are going to be really strong.
Yeah, the election's not going to hurt that at all.
Okay, that's a good point, John, because you've probably heard us share our stats before that so normally, and again, this is looking at a pre-COVID year, normally home sales go down from October to November, of course, makes sense, but in an election year, they go down more dramatically. And then in December, with all of we've gone back 50 years, then come December, home sales go back to their normal seasonal pattern. And what I don't have an answer to, but in normal times, uncertainty creates pauses, creates people to say, hey, I don't want to spend, I don't want to make a big move right now. What we've seen this year is some of the strongest housing markets are Minneapolis and Portland, because the protests have created uncertainty, and the social unrest has created this idea that I want a safe haven. And COVID has created uncertainty like we've never experienced before, and yet people are buying homes. So I don't know if this year will follow the normal November pattern, or if that uncertainty caused by the election actually just keeps us on course of, hey, I want to find something that's my own, and I want to be able to be safe in it and be able to escape. I think that will be really interesting to see, but I don't have a better answer than that.
That's a good answer. Better answer than I would have had.
Well,
Thank you so much, Allie.
John, you're talking to people all the time too. How have you guys seen the plans for the next couple months?
I mean, our builders that we talk to are selling dramatic amount of houses, and you know, they're building their backlogs. You know, one of the challenges that they're facing obviously is, you know, where are they going to get the labor, where are they going to get the supply? So, you know, there's a lot of jockeying going out there, and a lot of self-interest probably along all the different folks. So, you know, we've had success with, you know, just finding partners and builders that are having longer term relationships are having more success in working through that backlog. So I think, there's builders out there that long-term strategies are paying off and they're taking share. We appreciate your insights, Allie. We at BMC thank you so much for being here, and we thank everyone for tuning in. And if there's no more questions, Jack, we'll probably sign off.
Nope, I think that's going to conclude our session today. I wish everyone a very happy Friday and have a terrific weekend.